U.S. stocks took a little bit of a breather here today as all four U.S. equity indices were lower, anywhere from about 0.6% to 1.2%. However, despite the pullback, we do still find that we have bullish postures across the board from an intermediate term perspective, according to the market forecast. In fact, we have bullish intermediate confirmation signals existing on all four of our indices here today. I want to take a little bit of time to kind of show you some differences in those particular setups. I also want to take a look at one particular sector that seems to be bucking the trend, and that's consumer discretionary. We want to focus on a bullish trade setup within that particular sector in our trade application. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 9th, 2019. First of all, if you are new, welcome aboard. Go to our YouTube channel, click subscribe, and while you're over there, check out our description area to sign up for our email distribution list as well. We're also on Twitter. Feel free to follow me at Brandon Van Zee. And anytime you see these videos floating around for the Market Outlook, we would encourage you to click like and retweet if you get value out of them. In addition to that, we have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into the charts. As you can see, I've got chart 4B pulled up here in front of us for those of you that are premium market scholars that want to follow along at home. And as mentioned during the intro, you'll notice that all four of our indices were down here today. The NASDAQ did the best on a relative basis. It was only down 0.56%. And on the worst, it was the Russell 2000, which was down 1.22%. Now, having said that, you will notice that all of our background colors of our four charts remain in that darker green territory. And the background color I'm referring to is kind of back here behind the candles themselves. And so what that signifies is that according to the market forecast technical indicator, which you can find on the Thinkorswim platform, we continue to have a bullish intermediate term posture. And remember that bullish intermediate term posture occurs when the green line on the market forecast is either in the upper reversal zone, like it is in 3 out of these 4 charts, or simply rising like it is down here on the Russell 2000. Now, in addition to those bullish intermediate postures, we also have a specific trade setup known as the bullish intermediate confirmation signal. And I did have a comment about this the last time, and so we'll clear it up right here for once and for all. You can have a bullish intermediate confirmation signal even if the green line is not in the upper reversal zone. For instance, down here on the Russell 2000, notice that green line is rising between 20 and 80, and you can see that right in the label here if it's harder for you to make out with the naked eye. So the intermediate line is at 70.92 and rising. And so if that is the case, that is a bullish intermediate posture, and therefore it makes sense that we could also have a bullish intermediate confirmation signal since the core part of that is having a bullish intermediate posture to begin with. And then the confirmation signal occurs when we get the red line in the lower reversal zone. And notice that that is the case with all 4 of our indices here today. So all 4 of these indices do have bullish intermediate confirmation signals, but as I mentioned during the intro, there are different ways to look at these particular setups and try to determine which of them look better than others. So some of the things that you've heard David and I mention over the last few months and years, quite frankly, is that if you get a bullish intermediate confirmation signal, oftentimes we find that the setup is better going forward if the blue line, which is the near-term line, is in between 20 and 50. And you'll notice that is really only the case in a couple of instances here. So notice, again, you can kind of use these blue labels on the charts right here to determine whether that is the case or not. So in the case of the S&P 500, it's not between 50 and 20. In the case of the Dow, it is. It's at 29.5. So that blue line right there is right between 50 and 20. Down below here on the NASDAQ, that is not the case because its near-term line is at 62. But it is the case down here with the Russell 2000 because it's at 45. So that is, of course, between 50 and 20. So what we have here are 4 charts that have bullish intermediate confirmation signals. 2 of them have a more enhanced setup where we have that near-term line where we like it between 20 and 50. But then we'll take it one step further, and something that you've heard David probably mention a number of times is that if the red line goes down too far, it can spell a little bit of difficulties going forward. And a lot of times what he uses as too far is 5. And you can see down below here the Russell 2000's momentum line. Again, that's the red line on the market forecast. It's at about 5 and falling, whereas the Dow Jones is only at 12 and falling. So when you kind of think about all those different kind of setups and the way that you would approach this particular signal here using the market forecast, from that theory, it does suggest that the Dow Jones appears to be the chart out of the 4 that has the most viable setup. And you know, for those of you that aren't familiar with the concept of the bullish intermediate confirmation signal, it's basically a buy the dips mentality. It's basically a way to say that the green line is telling us that markets are still bullish. The red line pulling back is telling us that we have a momentary dip in price where it's time to reload the gun to the upside once again. And as you look at the Dow Jones, you'll see that its price action appears to be a little bit stronger than we see with the Russell 2000 as well. With the Russell 2000, remember, we just recently got over that moving average. The moving average line, in this case the 30-day moving average, is still yellow, telling us that we do not have price above a rising moving average. Right now, price is above a falling moving average. But you'll notice that we did not hit a new high. That previous high was back here February 25th, and in this most recent run on the Russell 2000, we didn't achieve a status higher than that, whereas that was the case with the Dow Jones. You know, despite all of the hairiness with Boeing, of course, being the most influential member of the Dow here recently, the Dow itself was able to go on and hit a new high above where it was trading back here in late February. So all that kind of leads you to suggest that, you know, if you're going to take bullish action based off of the, you know, bullish intermediate confirmation signal, that the Dow Jones appears to be the one that has the most viable setup. All right, let's go ahead and now take a look at our next chart setup. This one will be chart 4C, and this is our 3 green arrows chart setup. Right now, we do have 3 green arrows across the board on all 4 of these charts. We can see that very quickly by seeing that light green background color behind all of our charts on this particular chart 4C foregrid that we're looking at here. And so, again, you're trying to do your best by determining which of them look better than others. Again, same concept holds true down below here with the Russell 2000 probably drawing the short stick in that conversation because you, again, do not have price above a rising moving average, and you have a stock that has failed to break through its previous high. So despite the fact that it does have 3 green arrows right now, it might not be the most robust trend. For most robust trend, you know, you could probably take a peek at the NASDAQ as being a little bit more substantial than some of the others. Remember, the NASDAQ was actually down the least amount today. Remember, the NASDAQ composite is typically viewed as more tech-heavy composite that's out there, or index that's out there. And technology has been kind of our leading area of the market here recently. A lot of times people think that when the stock market goes down, technology stocks should go down further than, you know, more defensive areas or what have you, but that might not always be the case, especially when those particular stocks have been the one that have been in favor and have been driving this market higher. In fact, this might be a good time for me to kind of step away from these charts to kind of show you some of the sector rankings here most recently. So give me a second to go on over here to the internet to explain that. There we go. And first of all, remember, if you are watching these videos on our website, we would encourage you to click like on Twitter. So thank you to the 86 of you that did that last time. I really appreciate that. And then also, if you don't have a Twitter account, if you want to give us a thumbs up on Facebook, you can just click this link directly below where you're watching it. And we also have an area to click like on our website itself. Remember, doing all of those things sends us the message that you want us to continue to do these videos. Also, quick reminder that we have lots of excellent premium classes going on every single day here at Market Scholars. Earlier today, I taught my dividend growth investing class where we focused on the financial sector. David did teach his directional options class earlier today as well, so check out those recordings. And then tomorrow, David's got his options inventory management class at 11 a.m. Eastern Time, and then I've got my Strategy Lab swing trading class at 2 p.m. Eastern Time. All right, let's take a peek now at the sector selector to kind of get a sense of what's been going on with sectors here recently. Remember, I post this on Friday nights to our website, and I generally share the top portion of the graphic with the general public, and then the bottom portion, which is much more detailed, is usually exclusive to those of you that are premium members of Market Scholars. So let's talk about that top portion here, just to get a general sense of what's been going on with some of the sectors. Mentioned before that technology has been a leading sector, and that's part of the reason why the NASDAQ composite has held up a little bit better than some of those other indices. You'll notice that for the fourth straight week, technology is kind of the reigning king all the way at the top of the heap there of those sectors. Real estate did a pretty darn good job holding its place in line there in the second place. And the reason I said it's kind of interesting or I'm impressed with the way that they held the line is you'll notice that their counterpart, the utilities sector, did fall from number 3 to number 4 week over week, and they actually fell the week before that as well. So where we do see some interest rate sensitivity affecting the utilities sector, so far it hasn't caught up with the REITs that are out there. So it makes it a little bit peculiar, but REITs are being a little bit more stubborn than you might have anticipated, at least at this point. The utilities fell, and in their place was the industrials. Notice that industrials rose from the 6th rank all the way up to the 3rd rank on a week-over-week basis. So that's a little bit of new blood there for us to kind of sink our teeth into. And of course, we use this graphic every Monday in my top-down trend trading room that I hold at 11 a.m. Eastern Time. On the downside of this graphic, you do see financials taking its 3rd straight week at dead last at 11th slot, and energy, after going up for the previous couple of weeks, kind of settled back down into the 10th ranked spot. Also, before we take off from this view here, I did want to point out that discretionary had a nice jump week over week from number 8 up to number 6. So although it's not up in that kind of really, really exciting level in the top 3, the fact that it jumped 2 whole ranks week over week is worth kind of sitting up and paying attention to. Reason I'm pointing that out is our trade application example later on in this video will revolve around the discretionary kind of mindset, or at least once upon a time it was discretionary. I got to be careful there because, of course, a lot of those discretionary stocks ultimately went to the communication sector. But having said that, you'll also notice that communications did go up 1 slot week over week here as well. All right, let's get back over to the Thinkorswim platform and wrap up that particular analysis. Let's go ahead and take a peek here now at our 1040 crossover method chart. Remember, this is a longer term view here that we're looking at now. This is more of the 3-year variety here. Remember, the other charts we've looked at have been 3 months. So this is 3 years that we're looking at on these charts. Each one of these candles represents 1 week in time. And each one of these charts features 2 moving averages, a 10-week moving average and a 40-week moving average. And what we're looking for are crossovers of the moving averages themselves. And we do have something that's rather noteworthy taking place here today. And that is occurring down below here on the Russell 2000. Now you'll notice we're starting to get a little bit of this green color all the way to the right-hand side of the chart of the Russell 2000. And the reason for that is we are starting to experience a bullish crossover. Notice that as you look down below, in fact, let me do this. I'm going to right-click on the chart itself. Let's maximize that so that way you guys can see it in a little bit greater detail. Notice that the black line down below here on the MACD2 line setup is just crossing up and through that pink horizontal line. In other words, it's telling us that we are having a bullish crossover on these moving averages up above on the price chart itself, where the 10-period more sensitive moving average is going up and through the 40-period less sensitive moving average. That is generally perceived bullishly. Now, before we get too excited about that, let's keep in mind that today is only Tuesday. This candle doesn't look all that healthy that we see so far this week, and this candle will continue to be formed throughout the rest of this week until Friday's close. And so if we do have a further sell-off in the Russell 2000 by this Friday, remember that this crossover doesn't have to hold. Right now, I'm giving you a heads up that it's looking like it might, but it won't be set in stone until Friday. And so I'm sure David and I will let you know if that becomes official at the end of this week. But it is noteworthy because remember, the Russell 2000 was the laggard of our group here. It was the only one out of our 4 major indices that had not yet had that bullish crossover. The others have done it several weeks ago. Let's go ahead and now take a look at some 12 grid analysis, starting with the intermarket analysis. This will be chart 4E. And as a reminder, when we're looking at these 12 grids, the background colors of the charts will tell you that whether the market forecast intermediate term line is showing you a bullish posture or a bearish posture. And so on this first set of the 12 grids here, you'll see that there are 2 different pink charts on the board. That's TLT and that's AMLP right up here. And that pink background is telling you that we have a bearish intermediate term posture on those. And remember, you can look at the label up above to kind of verify that. Remember, when the line is below 80 and falling, we do consider that bearish. Now, if it's not down below 50 quite yet, remember, we would consider that weakly bearish if you want to kind of fine-tune that a little bit more. But nonetheless, we would still consider this bearish, and the same thing can be said down here with the TLT. All the other charts still have a bullish posture. So some of the things that have been kind of in the news here recently, of course, everybody likes to keep their eye on what's going on with the VIX. With a bigger pullback day in the general stock market, it is to be assumed that the VIX would have an outsized day as well, and that was probably considered the case. VIX was up about 8% today, so that's a pretty decent size day there for the VIX, but keep in mind context here, we're still near multi-month lows there for volatility. Other things that people have been kind of watching here recently is what's going on with interest rates. So the TNX chart up here does show that TNX was down today. In other words, interest rates fell today. However, it retained its bullish posture at this current juncture. I don't know how much I would trust it because, you know, my eye looks at this chart and sees a reversion to the mean type of a move here, approaching that falling moving average, and now starting to kind of curl over. So I'll be curious to see how long this bullish posture will last on TNX, because my own hunch is that I could envision some bearishness coming out of it sooner rather than later. And of course, the flip of that is U.S. government bonds. Remember, bond prices move inversely to interest rates. And so when rates are falling like they were today, of course, bond prices were up. And that was the case here as well. And so kind of the opposite mindset, where it does show that we have a bearish posture on TLT, but I wouldn't be all that surprised whatsoever to see that revert back to a bullish posture here in coming days if we can get another little bit of a boost to the upside. You know, we had this reversion to the mean back towards the moving average. It approached the rising moving average in this case and is kind of using it as almost kryptonite, bouncing away from it. So that would generally be perceived as kind of a bullish thing there for this entity, which is, again, U.S. government long bonds. U.S. dollar had a decent day. You'll notice that as I right-click on it, go to maximize sell, the candle looks better than the end result. The end result was that it was just up 0.04%, but that's only part of the story. The other part of the story is that the dollar gapped down to start the day and closed effectively at the highs of the day. So that's very bullish intraday price action, even if it's not really giving us a whole lot to write home to mom about at the end of the day in terms of, you know, close over close increase. So remember that the dollar will affect other things like commodities, etc. So let's talk about those commodities now. Gold is starting to have an interesting spiraling effect taking place on its chart. Notice that we have a set of lower highs here on gold, and we also have a set of higher lows here. and we're curling up as it stands right now. A pretty nice day for the gold futures contracts, up about 0.5% here. And so we're kind of in the middle of that coiling action right now. Perhaps some of you would be comfortable selling an iron condor on GLD or something along those lines when you're kind of in the middle of the range. Others of you might be waiting for a breakout in one direction or another to try to play it a little bit more directionally. The ag commodities pulled back just a little bit here today, down 0.3%. Not a dramatic pullback, but worth notating that ever since having this kind of big breakout day here last week, it's been 3 straight days to the downside. So a little bit of a whimper after that breakout. And then crude oil has been one of the key stories of 2019. Notice that yesterday crude oil received an overbought cluster signal, and so not a huge surprise to see it down a little bit today, 0.45%. But all things considered, this is still a strongly uptrending security right here, and that's a temperature of, you know, risk on mentality within the marketplace when crude oil is strong. Let's take a look at our next 12 grid now. Coming on over here to chart 4F, which will be our foreign stock markets 12 grid. All right, as we look at this, we can see one pink chart on the board. That's Australia. They're kind of in the middle rung. And so that's our only bearish posture according to the market forecast intermediate term line. The others are bullish postures, but they probably give you different setups depending on, you know, what you're kind of hoping to achieve and whether you're a breakout trader or more of a bounce trader or what have you. You know, one of the things that caught my eye here recently is that Mexico is kind of, you know, getting shot out of a cannon right now. Notice that EWW for the last 4 days has really been on this really nice move higher. It was down today by 0.39%, but the 3 days prior to that really launched this thing through that prior horizontal resistance area. So keep your eye on Mexico. This might not be the best time to initiate a brand new trade since we did have an overbought cluster, but this looks to be the type of setup where we might have a little bit of a rollover back towards the breakout zone. So we have a breakout retest and then a bounce off of that retest is what you'd be kind of, you know, focusing on as a bullish trade going forward. So maybe a little bit premature, but nonetheless, keep your eye on that possibility existing. You know, some of the other trades that look interesting out there, Russia has had some nice days here in the last 3 or 4 days as well. We're up there near 3-month highs on Russia. And keep in mind when oil prices are high and trending higher like they are right now, that generally benefits Russia. Remember, a large portion of their public equity markets are large oil companies. Other charts that look decent are China as well. Notice that China was down the last couple of days, but is just within a stone's throw of 3-month highs. Let's now take a look at what's going on here in the United States with chart 4G. All right, as this pulls up, you can see only one pink chart on the board, so the only bearish posture we have is on the utilities sector. All things being equal, that's probably not the worst sign in the world. Remember, if you want to have a really healthy stock market, you're hoping that the more cyclical areas are attracting investor interest and you're comfortable with the idea of the defensive areas kind of getting left in the dust. So that's not necessarily a big concerning element of this market right now, but nonetheless, just be aware of it in case you are looking for various bearish trade setups. Perhaps there's something to be said for, you know, digging your way through some of those utility individual stock charts that exist out there. One thing that I did want to point out was that the communications area was up nicely today. Notice that XLC was up 0.27% to the upside, so a fairly decent day there. And I also wanted to point out that the discretionary stocks have been on this really nice run here recently, although they were down 0.9% today, but still one of the more stellar runs. If you look at the distance between where discretionary is versus its moving average, you have a lot of separation there compared to a lot of the other sectors that are out there. And so it just goes to show you that there is bullish interest from traders in those areas. And so that's where I wanted to kind of focus our trade application example today, and that's going to be on Disney. Now, for those of you that kind of know the history of the juggling of the sectors here over the last year, you'll know that a year ago, Disney was considered a discretionary stock. It would have been part of XLY. But along the way, there was some transitions that were taking place amongst the sectors, and there was a newly created communications sector, which is now kind of shown through XLC up here. And the communications sector started kind of with the telecom companies of the old telecom sector, so Verizon, AT&T, etc., but then also started scooping in a lot of those media names from the discretionary sector, and then also some of the internet names from the technology sector. So it kind of made the communication sector a little bit more robust. I was actually having a conversation with David the other day. He stopped by, and we were having the conversation about how it makes it a little bit more difficult to analyze communication sector now, because it's not quite as clean cut as it once was. On the one hand, you have some really big utility type of companies like a Verizon in there with big juicy dividend yields. On the other hand, you have a Facebook in there that doesn't pay a dividend at all. So you don't really have that interest rate sensitivity conversation. So it's a little bit more of a mixed bag with communications these days. But nonetheless, what we can say is that communications does have a bullish posture. And we do have, a sign of relative outperformance here today, as it was the best performing sector, just barely nudging out XLU, which is up 0.24% here today. So let's have a conversation about Disney. I'm going to come back on over here to chart 4A, and we're going to take a look at ticker symbol DIS. Of course, many of you know Disney. Some of you that have kids probably know it a little bit better than others, but nonetheless, it's a name that most of us probably grew up with, at least those of us that grew up here in the United States. And so a well-known entity, part of the Dow Jones Industrial Average, which kind of weaves itself back into that initial conversation I had at the beginning of this presentation, saying that, hey, the Dow Jones looks to be the one that has the most legitimate bullish intermediate confirmation setup. So perhaps Disney, being one of those big lumbering giants within the Dow, could be an interesting choice to select for a bullish trade setup here today. Now, of course, the real reason I wanted to look at it is because this particular stock broke out here today on a day when most of the other markets were struggling. Notice that Disney was actually up 1.65% today, and the candle looks like this, a pretty substantial candle where we closed near the highs of the day. Not only that, but we blasted through this important resistance area that we saw back here as well. Notice we had some horizontal resistance at about a 115 level, somewhere in that general vicinity. So you could go on record saying that this is the highest close for Disney in at least 3 months, which is what this chart represents. Now, of course, the background color of the chart is telling you that we have a bullish posture on it, according to the market forecast intermediate term line. In addition to that, we have the market sentiment line that is rising now as well, after taking a little bit of a breather there for a while. So that's maybe setting up for some longer term mentality. We also have an interesting rebound off of oversold conditions. Notice that we once had an overbought cluster over here. It ended up going sideways, then started plunging to the point where we got an oversold cluster right here, and that's when all of those colored lines on the market forecast are below 20 on the same day. And then ever since putting in that oversold cluster signal, we've just been rallying furiously day after day after day, it seems, until we got to where we're at right now, which is a breakout. Now, some people are uncomfortable with breakouts because they feel like they've given up way too much of the trade. This one's a little different from that perspective as well, because Disney is still underperforming the general stock market on a year-to-date basis. And a big reason for that is, in order to start with this breakout, it had this big breakdown in price first. So it's not like you're looking at a stock that's up 50% year-to-date or anything along those lines. It's just that this stock has done a really good job in the last few weeks going higher. And there was a brokerage upgrade here today and some positive catalysts with some of their movie lineup. Of course, they own a lot of those superhero movies and Star Wars and different things like that. And of course, trying to launch their own subscription service against Netflix going forward as well. So possibly some catalysts in the hopper there as well. So what I thought we would do today is try to take advantage of this bullish trade setup through what's known as a long call vertical spread. So for that, let me take you on over here to the trade tab, where I've already kind of got it loaded up down below here in preparation of the video. What I'm using for this is the May monthly contracts with 38 days left until expiration. Now, traditionally how we set these up is we buy one in the money and we sell one out of the money. And when I say one, I'm referring to calls. So we're not talking about puts here. This is a long call vertical spread. And so we buy one long call that's in the money and we sell a call that's out of the money. And so right now with the stock close to, let's call it 116 or in that vicinity, the at the money strike would be the 115. So if we bought one that was in the money, 110, and we sold one that's out of the money, 120, this is what that trade looks like down below. Notice that this is a debit spread. However, it's one of those debit spreads that I kind of like. Some of you will recall we did a very similar setup to this on Apple here a couple of weeks ago. That's worked out reasonably well thus far. But I like these setups where we have a little bit of a step in the right direction. We get a little bit of a head start in the trade. And what I mean by that is our break even on this trade would effectively be the debit plus the long call. So if you took $110 plus 604, basically is $116.04. Now, the current price of Disney is $116.86. So in other words, we've got 82 cents worth of a head start in this trade. If this stock didn't do anything, it just stayed at this exact same price for the next 38 days, theoretically, we would win this particular trade. Now, we're not going to win a ton, but we'd win something. We would make money on that particular trade. Now, what we actually want to occur is for the stock to go up above 120. So what you're hoping for is with the breakout here today above that resistance area, that kind of clears the path of least resistance to the upside for Disney in the next 38 days. If we can get it to close above 120, then we have the possibility of making, a possibility of making almost $400. So we'll see if that occurs or not. But it is a good example of a long call vertical spread from a paper money perspective for those of you that are learning the strategy. So let's go ahead and just send that one in and wrap things up here for the day. All right, thanks for joining me once again. Remember, if you got value out of tonight's video, make sure you click like and retweet on Twitter. David will be back with you tomorrow, but at this juncture, we do have bullish postures across the board, bullish intermediate confirmation signals across the board as well. So we'll keep our eyes and ears on the news. We've got earnings coming up here from a lot of the big banks later on this week and next week. So anything can change technical analysis from the news category, but right now, we certainly have a more bullish market environment than bearish. And so that's where we want to be positioned. With that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.